Allen, how are you doing today?
I'm doing well. Thank you. Thanks for having me.
Of course. Thank you for joining us today. So, before we dive into the questions, tell us a little bit about yourself. What's your background?
Original background is really finance. 2011 got into Northwestern Mutual. Had a great career there for 9 years and phenomenal company. Their sandbox is a bit predefined, I guess you could say. And so as I started getting more experience in the industry, decided that I had clients that wanted to do things that were perhaps a little different than what I could do with that structure. So ended up leaving there, went to a smaller firm out in the RIA space. Was there for almost 4 years, and then decided to even take it up another notch, and then formed my own firm. So we're RIA fee only. We're based out of Wilmington, North Carolina. So we did that last June, and yeah, so we've just been running with that. So we have two advisors. It's one me, and then we have another group that's out of Pennsylvania that works with us as well. That we essentially brought in their book, and a bunch of great people there too. So yeah, that's majority of the history. We've owned a variety of other businesses as well, which will kind of lead into the rest of the conversation. A lot of it being real estate related. So yeah, I think everything that we're doing here and working with Madison Trust is a lot of synergy between the two options here.
Amazing. So, I think, was it Seaside Capital Partners you started last June?
Yeah, so at the same time, we did Seaside Capital Partners and Seaside Wealth Advisors. And so yeah, Seaside Capital Partners is the management umbrella for our currently we have one fund, and we're getting ready to launch another fund probably maybe by mid-June, maybe toward the end of June. It just depends on how quick all the attorneys decide to work. If you're watching, hurry it up, please. But so different objectives. Different investors have different objectives with their money, and so we wanted to create hopefully just a family of different funds that people can get involved with to just help their asset management and wealth management goals.
Amazing. So, talking a little bit about your fund or the funds you have, the investors, are they majority of them through IRAs, individual? Tell us a little bit more about your fund, how it's structured, and all that stuff.
Yeah, so the current one is a 506(b), and there's a bunch of tricky stipulations with that about who can participate. You typically have to have an existing relationship with the manager, which is my wife and I in this case. So you also could be a wealth management client. So if you're already in our firm, then you can participate in it. Aside from that, it's completely a private offering. It's not something we market. It's not something that's kind of out there as, hey, reach out and you can participate. That one is specifically set up to do really three different sleeves. So we have inside of it, we have joint venture. We lend to people that are going to be borrowing money specifically for the purpose of real estate development and real estate enhancement. And then the fund, we haven't done this yet, but we also have another sleeve of doing our own developments. And our mix right now is about 70-30. So around 70% of the investors are investing through IRAs, and about 30% are cash investors or non-qualified investors, if you will. The difference, if you're not familiar, of course, is IRAs are going to be tax deferred or ideally tax free too if you're doing it inside of a Roth IRA. And if you are a cash investor, you're going to receive a K-1 each year for tax purposes, and you're going to pay tax on your pro rata share of the fund performance.
Amazing. And what types of investments do you get excited about for utilizing IRAs, especially self-directed IRAs?
Yeah, I mean, outside of the stuff that we're doing in our funds, we have clients that have participated in, oil and gas ventures. I've had people bring things to me before to help vet and figure out if it's something that makes sense. And I don't think anyone has all the good ideas locked down. So I love looking through that stuff and figuring out what else is out there. But I think that even if you weren't working this through an advisor, if somebody just went straight to Madison Trust and you had, a couple $100,000 in an IRA and you want to do something a bit more exciting with it, perhaps, and diversify out of the market a little bit, even investing in a business, whether it be, someone that you're close with, a friend or whatever it is, you can make investments out of your IRA to a business for private equity. If you need to lend a business money, you could do it straight from your self-directed IRA. one of the coolest things I think that's out there is having a Roth in particular, obviously for the tax benefits, is go and have your IRA buy a house. Your Roth, go buy a house. Let's just say it was 100 grand and you put 50, $60,000 in the house renovating, you can sell it for say 250. I mean, imagine making $90,000 in a period of maybe 3 to 6 months and that rolling that right back into your IRA. I mean, you're at that rate, I mean, you're plugging away a 30% annualized return, and you just go the next year and you do it. You probably want to do one for income too, so maybe do a couple projects each year, but do one of them inside of an IRA, just strictly for that performance aspect. And I mean, it's just such a wealth hack, in my opinion. I mean, your IRA can go and take on debt as well. I mean, it has to be non-recourse,
Hmm.
not go and guarantee a loan that my IRA is going to take out. But that IRA can go and take a non-recourse debt, meaning that only the IRA is liable for that debt, and then you're like super leverage. I mean, you can go and using someone else's money to then enhance at a significant level the rate of return you can put inside of that. So, but I mean, there's the options are completely limitless effectively. And if you have really specific questions, you're welcome to ask me. Uh, but I would certainly recommend checking with an attorney too, because they're gonna know a lot of the self-directed IRA rules. I'm sure you guys do too, obviously.
Absolutely. Now, I'm actually curious. I have a few things that popped up in my brain when you were talking. With regard to the first one is, in your experience, what's the most exciting alternative investments you've seen, like clients come to you with? You said oil and gas, but what's the most unique investment?
Yeah, I mean the oil, honestly, the unique wise, there's two of them. Uh, I vetted out one where somebody was going to do a warehouse earlier this year. And that was particularly interesting because the people that were going to develop it were also the builders, and they also had owned the land for a really long time. So the value of the land was completely insane. And the way that they were trying to structure it was they were not going to have their investors necessarily buy part of the equity out of the land. So that was almost excluded. You could basically say on paper that they were just contributing the land to the deal, right? So and then so if you came in as an outside investor, the return, if they're this person didn't end up doing this deal for their own reasons, but if you ended up doing this, I mean, I think that they were trying to raise $5 million. If they pulled the entire $5 million in, there's going to be something like 12 or 13 million that was returned over a 5-year period to the investors, which is pretty substantial. They were
Mm.
essentially going to build it, they're going to stabilize it, and they're going to sell it, is what they're going to do. Probably look for an institution coming to buy it. Another one was actually an oil and gas fund, and it was an oil and gas company. It wasn't a fund, and they were just looking for participants in some new wells they were going to put in Texas, somewhere in Texas. And that was particularly interesting to me because it was a big income play, and they had enough history to where they could see just in that general area how much oil they could extract over a certain period of time. And it was something like $110,000 per unit, and they were selling 10 units per well. And for each unit, it was generating something around 4,500 to 6,500 a month in income. And it would run for a pretty long period of time, like 2.5 to 3 years is what they're anticipating. So the return on that, especially from an income standpoint, was pretty substantial. So if you just ran it out over a 2-year period, and that was nearly 100% cash on cash rate of return over 2 years, so you could call it 50% annualized, maybe 65% annualized. So those are all pretty unique for sure. Those are probably the I don't know, the neatest ones I've seen. There's all sorts of real estate syndications, things like that, where they'll pay a preferred return for people, and then they look at you know, having some sort of disposition after a few years so they can do a kicker at the end for whatever the profit was and the appreciation. So, but those are a dime a dozen. There's so many groups trying to do syndications to buy multifamily real estate and things like that, and a lot of times the pref rates, and especially right now with interest rates being really high, it's just frankly, in my opinion, not that attractive to not have control over it. So, I like the lending space a lot, and I like the development space because it's tangible. We can take collateral on properties. We vet borrowers to make sure that, you know, they have a very high likelihood of repaying, of course. And to date, that's, you know, we've got a 100% success rate on that. But, you know, like, I mean, if we're being honest, it's not an if, it's a when. You know, when you're lending money out, something will go wrong at some point in time. But we feel like we are very capable of absorbing the project and finishing it. If someone wants to work with us amicably on those things, you know, I don't really think anyone wants to have to deal with foreclosures, but that's part of the big reason when we take, you know, we take title, we take a position on the deed of trust, so we have a bit more control on those things. The end game for everybody in that space is to make money, and we're small enough to where we can be very flexible for workouts. So hopefully we keep a really, you know, clean track record just by doing as best we can on the underwriting side. And you know, if we have to mobilize a group to finish a project in another state, so be it. We'll do it, and then we'll fire sell it. Maybe we keep it and rent it, and then sell it once it's stabilized. Who knows? The options are endless, and that's kind of a benefit of being on the smaller side too, I think.
Amazing. And in your experience, how do you calculate potential risk within a household who utilizes alternatives in a self-directed IRA versus a market correlated IRA? I know that was a mouthful.
No, it makes a lot of sense. I think it's such a double-edged sword because if you look at one aspect of it, for one, the SEC, FINRA, everyone's going to look at an alternative, and especially state regulators, maybe perhaps they don't fully understand what all it is. They're going to immediately just kind of throw their hands up and like, no, this is alternative. It's completely speculative. All the documents you're going to get when you sign up to enter a fund, whether it be mine or anybody else's, there's a lot of stuff in there basically to scare you out of doing it. That's how it's written out. But if you start thinking about some of this stuff, and I want to be very careful when I say it, like that ultimately by regulation, it is considered highly speculative and risky. But if you are an educated investor and you use some deductive reasoning, I think that also you could look at Apple, Amazon, any of these other tickers that you can put money into. They wake up one day with some very poor press. You know, there's another pandemic going about, and all of a sudden 30-40% of it vanishes in a day. So I think that there is also risk on every side of the table when you look at investing. So with that being said, I'll answer your question now. There's always so many different things to think about from that aspect. But if somebody had, say, $1 million in an IRA, and they said, you know what, we want a big piece of this to be maybe a bit more aggressive with the opportunity for higher returns. Typically, that comes along with a bit more risk. If they feel comfortable with the sponsor, which would be us in this case, and they feel comfortable with what we're doing, such as lending money or get involved with real property, I think that if something is backed by an actual asset, I'm a little bit more comfortable having someone, you know, maybe go up to 10, 15, 20% of what their total market exposure is. And if they're comfortable with that risk, if they were ordinarily a 100% equities investor, you know, I don't personally feel like there's a whole lot of difference. And of course, we're going to notate all of our conversations with that client. But I mean, typically speaking, I mean, I wouldn't think it makes sense for somebody to be more than 25, 30%, probably at the maximum. The biggest thing that we have to pay attention to with alternatives is liquidity. And so that oftentimes is one of my biggest driving factors for recommendations in terms of how much someone invests. I don't want the phone call where we're 6 months in and that money, and I have this like 10 bullet point page at the very front of my subscription documents that says, I understand that this money is going out and it is not staying in a bank account. It is going out to real projects. It is going out to someone else. It is being trusted with someone else by virtue of someone building a house, borrowing the money to go and work with a different developer, whatever the case is. You know, now we have collateral on those dollars that are leaving. But that is a very real thing. So if you come and ask for that money back in 6 months, which by the way, we have a 12-month lockup period, right? And a lot of funds have lockup periods. But if that money is not back right on time, they do extensions, things of that nature, you know, we're going to put you down on the list. You know, we're going to say, hey, if we get this money back, or if we have, you know, other LPs come in and we can help you withdraw sooner, we will. But it's just kind of up in the air. So the IRA thing, it all goes back to the IRA. The IRA client is an ideal client, especially if you're 30s, 40s, 50s, or even below 30s, but especially if you got some good time horizon. You can't do anything with it anyway, you know, so take a portion of it, put it over to the side, have some fun in alternatives. Pick up a rental property, let the IRA own them. You can do all sorts of things with it and generate additional income. And the liquidity suddenly becomes a lot less of a factor. And I think too, just from a sponsor's perspective, if you have one fund that's doing really well, then if you have other ones that pop up or another neat opportunity comes up, then maybe they fund that IRA a little bit more, and then we go into an outside venture, or whatever the case is. There's the overarching bullet point for me in thinking about suitability and how much someone goes into to any fund for that matter really boils down to liquidity. That is the one thing that I think everybody needs to take away from in terms of alternative investments is liquidity. Even if you're doing it yourself, if you go lend money to someone, that money is gone. And, it's going to come back when it comes back, hopefully at the time that it's supposed to by the terms of the promissory note. So, that's kind of the way that I look at it. I don't want somebody to be overexposed, but different people have different risk tolerances for sure. I would be way less likely to say 10, 20, 30% if you were buying private equity in a startup, right? Like that's to me a big no-no. Unless you own the startup and you are investing your entire life in it, probably not a good idea. We know that the failure rate on startups is extremely high, but we know that collateralized assets where there's something real backing it, there's a very high probability that even if something doesn't go right, we're going to be able to recoup the vast majority, if not all, of that capital, even if it takes a little bit of time. So that's kind of my philosophy on it. I like the real estate side is safe. I've participated in fundraising for other funds before that were unsecured lending to businesses and things of that nature, and it was just never my favorite thing, because if it's not unsecured, or excuse me, if it's not secured and you're lending unsecured, it's a lot tougher to get your money back and a lot more expensive if it doesn't come back.
I think a lot of investors out there do share the same sentiments, because real estate has been that one true asset type, especially in the alternative world where there's always demand, especially in the last few years. There has never been one year where real estate was going down, at least in my experience. And the
Yeah.
good thing is, right now, more and more people, Alan, and I think you can definitely speak more about this, they are turning towards alternative investments, towards
Yeah.
self-directed IRAs. They don't want to always put all of their retirement savings into the market with stocks and bonds, the usual, Wall Street products, and leave it there. They want to try to do a little something outside of the norm. And that's where sponsors like you come in, that give them that diversification strategy. But on top of that, passive investing, they don't have to be so involved in the construction, the development, the cash flows. They invest, they know exactly what they're investing and what's going to come out of it.
Yeah, you're 100% right. And our current fund was specifically designed to be a high yield fund. So, we're not doing a lot of construction loans where we're funding the entire project. I think it's too capital intensive. The timeline takes a long time. Our ideal scenario is that someone comes to us and they say, "Hey, we already have this very well known," and I know majority of them. We already have a very well known first position lien holder here. Those companies have massive budgets for underwriting. They have all these other things, and so I recognize the vast majority of them that come across the table, and they have very stringent requirements. They're doing background checks, they're doing judgment checks, they're doing all these different things. So if we have the opportunity, if someone's 3 to 4 months in, maybe they're 70% of the projects through, and this happens all the time, right? Like budgets kind of get mixed up. You have this or that pops up. You need an extra 20 grand, 50 grand, 100, something like that. And they come to us and say, "Hey, can you help us fill this gap?" Well, I can already see the debt that they have because we ask for it. We see who the lender is. We get all the same credentials that they ask for. We're still doing a credit check, and we'll come in, take a second deed of trust on the property. We'll place a lien or UCC lien on their entity, and make them personally guarantee all these other things, and verify their assets. Look at bank statements to make sure they can afford the interest. And if we come in that position, our minimum grade A interest rate is just 2% monthly, typically 2.5% plus. I think our average blended rate right now is like 2.7, 2.8% a month. And so it generates great income, for the fund. And that's really where we sit at for sure. And people pay it because there's also this aspect of, well, what's the alternative, right? So if it just becomes a cost of doing business. And we never have any issues with people being willing to pay that, because the quicker that the money flows, the quicker they can finish the project and ultimately save money on interest, and they can, get on to the next one. So that's really the ideal thing. We like that. Now, granted, we also really like first position stuff. So we work with wholesalers quite often. And for anybody listening that's not familiar, a wholesaler, I come to you, Donna, and I say, hey, your house is not on the market, but I'm interested in buying it. I think it's worth this, and I put it under contract with you. Let's say that's $100,000, and you say, sure, I don't have to deal with a realtor. I don't have to do all these other things. You're just going to go out and handle the whole transaction, blah, blah, blah. Right. So I'm going to go and take that $100,000 contract I've got. I'm going to go assign it to someone else. But what happens now a lot of times is because people have kind of wised up to that, and I don't necessarily disagree with this at all, is what was happening is that seller would come to the closing table with whoever the ultimate end buyer was, and they're going to see the number that the end buyer is paying. So if I turn around and assign that contract for $150,000, then you're going to feel like you got a little bit slighted at the closing table because you could have sold it for 150. And granted, you paid for some conveniences and this and that, but still, you're a homeowner, you have the value in the home. So there's that. So what happens now, a lot of times is wholesalers will bring capital to the table and actually close on that house, so that the title and deed and everything transfers over to that wholesaler, and they'll do a double closing. So maybe later that same day or the next day, the end buyer then closes and buys it from the wholesaler. And a lot of the wholesalers just don't have the cash to support that. So they'll come to us and we'll charge 1%, 2%, for that transaction. So if someone comes for that one day and borrows $100,000 to close the transaction with you, and it costs them $2,000, they also don't have an issue with that. So, why would they care about spending 2,000 to make 48 net? They don't. So there's a ton of capital opportunity on that side of things too, because you become this transactional lender, and they're incredibly safe because that money is going to just sit in escrow. The money never even leaves escrow. So it's a pretty awesome thing, but there has to be money in between those two transactions to actually clear it through escrow. So there's so many opportunities to make money in the private lending space when it comes to real estate, and what we've been marketing, trying to push more toward, is doing things like that. Or if somebody wants to take down a property, they need to do it in cash, and they're just waiting for their loan to close, but to be competitive, they needed to take it down in cash today. Then we'll do that. We'll put the money out. We'll take first lien position, then we'll just get taken out by whatever loan they're trying to get. And then for that, it's a fairly nominal fee. It might be 1% to 5%, for a couple week period. And every deal is just a little bit different. So our goal is just to generate as much alpha as we can to push back into people's IRAs and ultimately just enhance everything. But I think that's a goal, I'm sure, with most alternative investment avenues as well. I mean, you have control of it, and you can get super creative doing it. And that's kind of what gets us excited about it, is that there's such a big market for it, but there's just not a lot of people willing to do it. And you don't have the time to sit there and underwrite these deals and do it yourself, as you mentioned earlier. So, taking a passive approach on this is super beneficial for people.
Absolutely. And there's not a lot of educational resources out there about this. So there are a lot of investors out there that don't know that this is a potential avenue they can go. And that's why we have these webinars where we can talk a little bit more about this and just let people know there are other avenues. Now, we spoke a little bit of the investor side. I am curious to know a little bit on the sponsor side before we open up for questions. So what has your experience been raising capital since you opened up your fund?
Yeah, that's a great question. I definitely wouldn't say that it's easy. I think what's helped us a lot is, especially locally, we have investors, I think, in 7 different states. I've had pre-existing relationships with all of those people, including, wealth management clients that have already trusted me to manage their money, some of them for more than 10 years at this point. And so they've seen a lot of what I've done over the years on the wealth management side. They have seen, especially if they're local, they've seen the development that my wife and I put together over the last few years. We've done a lot. I think that between us and our partners, we had a big group, and we did a ton of stuff between 2020 and 2023, three when that big project got closed up, and now we have other stuff going on too with the same people. But I mean, it was probably saw us turn, probably close to 20 to $25 million worth of real estate in 3 years, between new construction and renovations and things of that nature. And so in a smaller town like Wilmington, North Carolina, where I live, there's 150,000 people, I think, give or take a few. It gets noticed. And so when you put together a fund like this, I think it makes it a little bit easier because you have a bit of credibility, or at least I like to feel like we do, and they want to get involved with it. And one of the reasons why we decided to put it together too is because we were on the receiving end of a lot of investors and people that are sitting around with cash that wanted to generate some additional money with it, with idle money. And so while we were doing a lot of these projects, we would go to people that we knew and we'd say, "Hey, do you want to jump in on this for the last 3 months? We've got a couple hurdles we got to get through. You got 100,000 you want to put somewhere for 2 or 3 months." And everybody's like, "Yeah, sure, sounds great." So they would jump in with it, and would get them paid off, and maybe they'd want to do a new one. So it was a lot of that kind of back and forth. And at some point we decided, maybe we should just formalize this to some degree, because it can get a little bit cumbersome if you have 6 or 7 different projects going on and you got money from, Paul and, whoever else. You got 15, 20 people out there that are just throwing money in. And so that was kind of how it birthed, really. But everybody I was surprised, even raising money for specific projects, how many people did have idle cash and just didn't really know what to do with it. And so that's why it became pretty easy to get shorter term money for these projects. And then putting the fund together, a lot of them decided to participate in it so that they could just kind of have it to work all the time. And they didn't have to worry about every individual project, because we do that. We come in and we vet the projects that we lend money to or get involved with. So, yeah, that's pretty much how it all came about there. Kind of lost my train of thought a little bit, but
All good. But it sounds like since you started the fund, and I think that was last June, right?
yeah, it's been right at a year. Yeah, so the fundraising back on that wasn't all that easy. It takes a lot of work. You have to put together a lot of due diligence stuff. You have to put together a very concise plan. A lot of people wanted to see the promissory notes that we were putting together. So, we had a couple iterations of those, had a couple different attorney opinions on them. There's just a lot of legal aspects with it. If we've lent money outside of North Carolina, we have to get involved with local laws in terms of usury, charging too much interest. But the good thing is, the majority of the states, it doesn't really apply so much to business purpose loans, especially if it's not a primary home for someone. So there's definitely a lot of work that has to go into it, for sure. But the IRA money, I think people are a bit more willing, because of the time horizon, to say, "Hey, I'm not 100% sure on this, but let's just give it a go." And they throw some in. We've had a couple investors that come back and done 3 or 4 different deposits, whether it be from cash investments or just adding money in from an IRA or adding their spouse's IRA, things like that. So the longer that we go, I think the more goodwill that we continue to build and trust with our existing investors. And I also think that inherently attracts other investors too.
Alan, it has been wonderful. And my final question to you is, are you currently looking for investors? And today, out of everyone who has shown up here and who will be reviewing this webinar after the fact, how can they get in touch with you?
Sure. Yeah. I mean, we're always looking for like-minded people to come in and work with us at Seaside Wealth Advisors as well. We do have this new fund coming up for Seaside Capital Partners as the income fund. It's very likely we'll have something else that we're going to do too. So there's just no telling what we're going to get into on a year-to-year basis. So at a bare minimum, if the timing's not even right, you can feel free to still reach out and get you on a list. But here, I'll share this real fast so that people have a good way to see our contact info. You can let me know if this shows up properly. So you can also send a text message to this phone number too. So that is our office line, but it does receive text messages. And that'll very much so serve for both Seaside Wealth and Seaside Capital. And yeah, happy to have open and honest conversations about it. Even if you just have questions around self-directed IRAs, if you're thinking about doing it, just give me a ring. Happy to be a resource. Obviously, Madison Trust is here to help too. And by all means, if you just have investing questions, just let us know. If you want to have somebody that can provide you a third party opinion and not really have a dollar at stake, then we're that's what we're here for. And so the 506B that we currently have open is pretty closed off to people that we don't already know. There's even deeper stipulations than that because, why not? Just legislation. It's perfect. And, but again, we do plan to do the 506C, which will be an open opportunity. So we can certainly keep people on top of mind for that if you have interest.